Welcome, ladies and gentlemen. Today, we're going to talk about California asset protection. We're going to talk about the California private retirement plan and the homestead exemption. I have Ray Olmo joining us, and he is the head of TRUST-CFO, and TRUST-CFO is a private retirement plan administrator in California. And as you'll see as we go through the materials here, this is a very important component to the California private retirement plan. Ray, welcome. It's nice to see you again.
Thanks for having me in 2021. It's going to be a great year and a kickoff with you, Jim.
All right. So let's get to it. We have, first of all, a disclaimer. I'm a lawyer. Ray is a private retirement plan administrator. This is information only. Okay. This is not legal advice. So don't run off and do something with this and, go out and take action based upon what we're talking here, other than seeking out a competent professional to help you with this. And also, if you're watching this on YouTube, please subscribe to our YouTube channel. It's a great way to stay informed. This is going to be a crazy year, 2021. Okay. Lots of change on the horizon, lots of tax law change, lots of legal change, a change in presidential administration. So you'll definitely want to subscribe to our YouTube channel and stay informed. I'm Jim Cunningham. These are the lawyers at our law firm. We have offices in Northern California and Southern California. And of course, now we're pretty much doing everything on Zoom during the pandemic. So we do live in a different world. And, I think back, right now we're in January of 2021, and I think back what the world was like 12 months ago. I mean, Ray, I never could have imagined this stuff was going to happen. Not in my worst nightmare, quite frankly. We're going through these just crazy times. And I will tell you, we are seeing from clients interest in protecting your wealth, what you have taken a lifetime to accumulate, is at an all-time high. We are seeing more and more people calling us saying they're worried. It's like fear has taken control of their lives. And I'm here to share some information with you to hopefully you dial back the fear a little bit and get some control in your life. By the way, we do have a Q&A button on the Zoom functionality. If you're watching this on YouTube, there's no Q&A, but you can put a question or a comment in the comments feature on YouTube. But go ahead and click that Q&A and you can write the questions. We'll be answering those at the end. Ray, are you seeing that with clients who are reaching out to you with private retirement plans? Are they worried?
Yeah, we had always been wary over the last few years of the recurrence of a 2006 through 2009 financial impact, whether it was real estate or investment or both. Again, that was what we were concerned about. Back then, we were up 300% in increased business litigation and business in that time, coming out of that from 2010 to 12. Now we're at 400% because of this COVID thing. So it's put a different spin on the fear factor for clients.
Yeah. So I'm really glad you're watching this. You're sharing your time with us to learn these important things. I do want to distinguish between asset protection and wealth preservation. So those are slightly different concepts. Asset protection planning organizes your assets and affairs in a manner to make them less vulnerable to claims of unanticipated creditors, and it's best initiated before it's needed. The example is, if your house is on fire, guess what? It's too late to buy fire insurance. If the rain's coming, it's too late to buy flood insurance, that sort of thing. You cannot start asset protection planning after a creditor appears. We're going to talk about why and what that law is. So you have to do this well in advance. And asset protection often includes use of trusts. Sometimes they're irrevocable trusts. Sometimes they're private retirement trusts, but there are a variety of trusts. Wealth preservation is a strategy that ensures your assets grow while providing a legacy for your family. So wealth preservation, there are a variety of investment plans that are all aimed at securing your wealth for the long term and building a lasting legacy for your family. So you can think of asset protection as defense and wealth preservation essentially as offense.
Now, if I can make one comment, Jim, and you know this, but all of our colleagues have shared this. Last year was a major precedence in a case law. I don't remember the specific name, you probably do, but last year in 2020 was the first time where a court opined and said that asset protection is actually considered a legitimate strategy. Mm-hmm. But what you're saying, again, needs to be clear. It doesn't mean that your hair can be on fire and now you can go and hide your stuff and evade creditors. It means that when the seas are calm, you do your planning. And the person that did that succeeded, and that's why that case came about. So again, there's a dual-edged sword, and you need to listen to Jim in terms of the spectrum of how you do your planning.
Yeah, and I look at it as, you have a safe, right? And you have stuff in your safe. You want to lock the safe, right? That's the whole point. And that's asset protection. Asset protection is closing the door, locking it. You do have a choice. You can leave your safe unlocked. You can choose not to engage in asset protection. And that is perfectly legitimate. Some people say, I have insurance. Well, insurance doesn't cover everything, right? We know that. So some people, they're just not particularly concerned about it. That's fine. It's the choice that you can make, but the default is no protection. The default is the safe is open, not that the safe is closed. So taxes. Here's how I think about taxes. And I'm kind of I like to think of things in the most simple terms possible. Your money is not your own. All right. You have a joint account with the government. I'm talking federal government, state government, local government. You have a joint account. Whatever money goes into that account, the government's going to get some of it. They're going to get income taxes. They're going to get capital gains taxes. They're going to get property taxes. They're going to get death taxes. Okay. And creditors are also on that account as well, right? So if you don't pay your mortgage, what happens? They take your house away. If you don't pay your bills, you get sued. If you enter a business transaction that goes south, you're gonna get sued. So your creditors are also, you can think of them as being on your account as a joint owner. California Avoidable Transactions Act, the California Avoidable Transactions Act makes it easier, and this is fairly recent, makes it easier for creditors to recover assets that are transferred to third parties. So that means like, oh man, this bad thing happened. I'm going to give everything to my wife, or I'm going to give everything to my brother. Yeah, and I'm going to somehow evade the creditor, right? You can't do that, right? That transaction is voided, right? It used to be called the Fraudulent Transfers Act, but now it's avoidable transfers. So if you have a liability arise and you give somebody some money, a court's going to unwind that potentially. Okay, that's what we're talking about here.
They put it in as the clawback. And when I originally read that, Jim, it was 2012 that got reaffirmed, and I read that, and they tried to soften the language. The hair in the back of my neck stood up, because it's basically you're guilty until proven innocent, and therefore the creditors have this overreach of clawing these things back. And it's scary how long that can be. Even offshore is almost, I think it's 12 or 13 years.
Yeah, and this is really important because when you do asset protection planning, you do not protect everything, right? That is one potential danger in engaging in asset protection planning. So you do need to have some assets. You cannot make yourself insolvent. But we're talking about asset protection here. And what we're going to talk about with the private retirement plan is something slightly different. Okay, so California has what I would call stingy exemptions. Now, what's an exemption? That means if you get sued, the creditor can't take everything, okay? You're going to get some exemptions. It is very stingy exemptions with one exception that's actually a positive note that happened last year. But basically, your cash investments, IRAs, life insurance, annuities, those all have very weak creditor protection. And frankly, for most of your assets, there is no creditor protection. So California's homeowners exemption, and this is, I want to explain to you what a homeowners exemption is. There is a homeowner's exemption on your property tax bill of $7,000. Now that's something different than what I'm talking about here. So the homeowner's exemption has to do with property taxes. It's that $7,000 you can subtract from your taxes. I'm not talking about that. What we're talking about here is how much equity you can keep in your home if you are successfully sued and a creditor is coming after your assets. It used to be $75,000 per person, $100,000 for both spouses, or $175,000 if you're over 65. Again, a stingy exemption. So one good thing that our governor did last year was he signed into law a bill that expanded the homeowners exemption. And Ray, I don't think this got a lot of press coverage, did it? I mean, I think it passed in August, and I didn't even find out about it until a couple months later.
Yeah, Newsom signed into law September 15th and didn't take effect until January 1st, so it's just now gaining traction. But he did upgrade the homestead exemption. If I may, quick sidebar, the best thing I've been able to do to educate my clients is kind of explain the terminology homestead exemption. If you talk about Texas, everybody knows and hears about, oh, Texas, you have a 1,000-acre ranch and it's fully protected. Or in Florida, you could have an unlimited amount in a quarter acre and it's 100% protected. But they almost can't fathom California. And so the myth has always been, they go, oh, is my house protected? No, California is a different animal. And again, Jim's right. There has been a step in the right direction, increasing it from the range of 300,000 to 600,000 with a deviation in between. It's, again, at least in the right direction.
Yeah, and what it is it depends on the county you live in. So if you live in San Francisco County, it's 600,000. If you live in Glenn County, I don't know, it might be 300,000. I don't know. I'm just picking a random kind of rural county.
I'll pick my county as an example. Placer County is 439,000. So I don't get 600, but I'm above 300. So my exemption of my equity, and this is an important factor.
Yeah.
I have to do the math of what is my equity, my home worth, my value, and what's the mortgage that I have on it. And so if I have a $2 million home and a $1 million mortgage, my equity is 1 million. And of that million, Ray has 439,000 exempt or protected. That means the rest is exposed.
Yeah. And they can sell it, force a sale, take the money. You get to keep 400,000, but it's not really that good because frankly, a lot of people have more than 600,000 in equity in their home, right? If you've been a responsible person and paid off your mortgage and you have an $800,000 home, you're not going to be totally protected. So this is all really depressing for many people. They're like, oh my gosh, another reason not to live in California. But there is a way for Californians. And I'm saying, California's great. I'm a California native. I love it. I'm a lifer. I'm never leaving. I love California. I love the weather. I love the people. There's a lot of other stuff I don't like, but this is one great thing about being a Californian. You can set aside assets for your retirement to be used in retirement that are protected under California law. And a lot of people don't know about this. It is not asset protection. It's not asset protection. It's even better because you're not evading creditors. It's about setting aside your assets for retirement. And it's a California private retirement plan. So California private retirement plan was passed in 1970. It is part of California Code of Civil Procedure, section 704115. It provides Californians a proven statutory mechanism to set aside designated funds in retirement that can be protected from lawsuits and third parties. So it's a way of protecting your assets, but primarily it's first of all, it's a retirement plan. So I'm gonna kind of walk through a high level, and Ray, you can kind of add some color to this. So how does this work? It starts with an actuarial analysis. That's what Ray does. We'll show you how to do that at the end of the presentation here. And what you do is you say, I need $5 million in retirement. It's a target dollar amount. It is funded with a note. What that means is you create a retirement plan and you put a note into the plan, and then it's secured by your assets. Now, what that means is, let's say, Ray, the example you gave, you have a $2 million home with $1 million in equity. You create a note inside of the private retirement plan, and then you lien your home, lien, L-I-E-N, you lien your home for the $1 million in equity so that there's no equity per se in the home, but that note is owned by your private retirement plan. And that's a way of zeroing out your equity so a creditor will not take that asset, and you can do that with other assets. What I mean by subordinated to lenders is if you need to refinance the property or you need to do something else, you release that lien and then you put the lien back on again. It is protected from creditors, but this is critical, and this is why Ray is here with me today. It has to be created and administered properly. If it is not created properly and not administered properly, what happens, Ray? What happens to it?
Yeah, there's a very black and white distinction between plans not done correctly, in which case that falls into the, I'm going to get sued. I better try to manufacture something last minute and try to hide my assets. And those that prove the true need, which is what Jim was referring to in actual analysis. That's the proof that, yes, I need this. And then, yes, I'm reporting on this properly. And yes, I'm promising and committing to fund my plan and committing, just like a defined benefit plan over time. So these are the metrics. And again, it's if you don't have these things, and there's like 186 major cases that have either made them bad case law or good case law. And again, the ones that have stood up, you rarely hear about, because at the end of the day, the creditors have no recourse.
Yeah. You only hear, it's like doctors don't see healthy people. They only see the people with the infections. All right. Very important. A private retirement plan is not an asset protection plan any more than a 401k plan is an asset protection plan. It is not. And this is really important. A lot of common question. Is it a tax advantaged plan? Do I get a deduction for this? No. This is what we call tax neutral. There's either tax advantaged or tax neutral. Tax advantaged means if I put money into this thing, I get a corresponding income tax deduction, some type of tax benefit. This is a tax neutral policy. The structure that is used is completely tax neutral. And by the way, the statute that was passed that we referenced, the Code of Civil Procedure, that was the model for the ERISA statute in 1974 that the federal government passed, because the federal government said, hey, lots of good things come from California. That looks like a really good thing. Yeah, people should save for their retirement. Hey, let's do this. Let's do this retirement savings plan and let's juice this up and give some tax advantage to it. That's what the federal government did. And so they modeled it on California's private retirement plan structure.
And then the irony is, again, we're a great state in innovating a lot of things, and somehow, some way, it kind of flipped upside down. But one of these things that hasn't been changed, not one iota in the statute you're referring to, because the federal government did make it a tax-oriented plan. And I need to make a distinction here, Jim, for our client base. There's a purpose. So when you're funding out of your income statement, you want to get a deduction, reduce your taxable income. That's the incentive, right? And then you're going to accrue it tax deferred, and then you're going to pay taxes on the back end. Well, that's typically sold with the financial industries, the investment portfolios out there, the stock market that likes to fulfill that plan with their products. Private retirement wasn't about buying investments. It was about private assets, real estate, private business interests, farming. Okay, all those people that were working hard, again, up into the 70s, and that's why the statute passed, is that, hey, we're not here to talk about taxes. We're talking about protecting this hard-earned money that these people are putting into their life, over their lifetime, and they need to be protected. And that was the true intent of that.
Yeah, and if you actually go to the statute and you look at it, it does include union pensions. So this is designed for people, not the ultra wealthy, although ultra wealthy people do use this for part of their assets. This is designed for sort of the mass affluent, right? This is designed for, frankly, many of the people that we meet with in our practice, the people who are 3 million to 20 million, something like that, and above 20 million, but that's the sort of bracket that we're looking at. So it doesn't work if it's structured to evade creditors. Okay. You can't say, hey, I'm going to do this to evade creditors. It doesn't work if it's administered improperly, and it doesn't work if it's ignored. This is not something that you can set and forget. It does require annual care and feeding. So that is something to be aware of, much like a 401k plan. If you're an employer, you know this. A 401k plan requires a plan administrator. It requires a trustee. It requires a lot of these things. So it does require some care and feeding. It can also work with tax planning strategies. And this is very important. It is not in and of itself a tax advantaged. It's not a tax advantaged structure, but the basic structure, for those of you who are lawyers watching this, and accountants, the basic structure is this is a grantor trust. So what you start with in a private retirement plan is a private retirement trust. It is a grantor trust. What that means is the trust is the taxpayer is deemed the individual who is making the contribution to the private retirement plan. So completely tax neutral. You can report this on your 1040, the income on your 1040. What you can't do is just kind of drop a piece of paper saying, I declare that my house is my retirement plan, because you can't really put a house in a retirement plan, right? You can't put your house in, you're living in it. Yeah. You can't just say, these are all my, you can't just declare that these are all of my assets. It doesn't work that way. You have to have a real structure.
You do, and you have to prove and document the need. In the case of a primary residence, the problem is twofold. It's number one, it's personal use asset. You're living in it for today's benefit. And the more complex version is California doesn't let you double up on exemptions, and you're already awarded the homestead. Yes, it's bigger, but that means you can't put your house in there. We've never done one out of all of our plans. We won't do it.
Yeah.
And so again, it needs to be an appropriate asset. And one last time before you move on, Jim, is again, the other kind of exciting thing for us is that the reason the private retirement plan is neutral because it deals with already complex assets that have inherent tax benefits. Real estate has tax defer, capital gains treatment, tax deferral treatment, 1031, depreciation. It is awesome. Life insurance. You don't need to bastardize those things and trying to refit them into a different bucket when you and I can strategize and already compress and reduce and enhance those values. And so that's, again, really criticalness is the style of asset that goes in this. You can capitalize on great other planning.
Yeah. So here is, let's see, I went the wrong way. So how do rich people, just slight digression, how do rich people pay less tax? Well, number one, they hire the best advisors. Number two, they listen to the advisors and they actually act. And three, they have the capital to deploy in a manner that results in less overall taxation. So it is true, rich people do pay less taxes. It is true Warren Buffett pays at a lower rate than his secretary, I guess I've heard. But it is true, and many of our wealthier clients, if you have assets, there are ways that you can place those assets into different vehicles or invest them in a certain ways that may result in less taxes. And remember, I said at the beginning that your assets are not entirely yours, that the government is a joint tenant on your accounts, right? The government's on your accounts with you. Well, rich people know that. And they're aware of that intellectually, they've processed that and they accept that, and they know to seek out the best advisors and take their advice. And that results in more family wealth, more intergenerational wealth. And that's probably why you're here. You're probably here to make sure you keep what you got and you can pass that on to the people that you love and the causes that you care about. So estate planning and business integration. So how does this all fit together? This is not a replacement for a revocable living trust. In California, a revocable living trust centered estate plan is the foundation. I'm not going to say for everyone, but pretty much everyone, right? Because I'm not, in law, there are absolutely no absolutes, but this is in California, the revocable living trust estate plan is the cornerstone of most planning. And then we add things. So it's like a cake, right? And the revocable living trust is the bottom layer of the cake. And then maybe the next layer is your private retirement plan. And you might have life insurance in there. You might have IRAs, 401ks, annuities. And so that cake just keeps getting layers on it. It should be integrated with your estate plan, right? They need to talk to each other. And it should be part of an overall business plan. And if you're a business owner, kudos to you, because 2020 has been a catastrophic year for many businesses. And some businesses, it's been the best year they've ever had. Very few businesses is it totally neutral, where not much has changed. And we don't know what's going to happen, and Ray, you and I read the same news, we watch the same TV, and I'm just seeing this pattern. It may be years before we even approach something like normal. And I think we're all kind of hoping and praying and feeling like, wow, if we can just get this vaccine, we're just going to go back to normal. But what I'm afraid of is we never will go back to normal. And this may have as big of an impact in the world as World War I had. I mean, World War I totally changed the world, and it may have a similar impact. And so the world will not, in 2030, the world is going to look fundamentally different than it did in 2020. And you need to be prepared, because we're going through a period of rapid change, and some people are ending up winners and some people are ending up losers. And if you're worried about losing your wealth through creditors or lawsuits, it's very important that you consider this type of planning. Very important.
I think you hit the nail on that head, Jim. Is that the interesting thing about this is whereas before we were dealing with people reacting to, oh, I just got handed a lawsuit. Now I'm frozen. What can I do? This has caused a ripple where people are kind of now in this wave of, okay, I'm not in trouble yet, but man, things are going to change for a while. So I can forecast that I'm going to get in trouble and have these issues. And yes, we're having a conversation about tenant landlord relationships with small businesses and those types of things. And while people are accommodating and the government subsidizing, you're right, that can probably hold on so long. Again, I think the good news is when people are proactive, they can drop a dome over the world. That's the model we like to say. Let's drop a dome over your world, let you sleep at night, let you breathe, and now we can do some proactive planning. And as you and I have been doing.
And thank you, Ray. And each of these are tailored to their own unique set of facts. So how do you get started? What's the next thing you do? What are the two things that you need to do? Go to CunninghamLegal.com. That's our website. So if you're watching this, you can minimize it or make it smaller. Go to CunninghamLegal.com. On our website, you click practice areas where it says practice areas. And I'm going to go through this and I'll go back as we're answering questions. So click practice areas. You'll see a drop-down menu, Asset Protection California. So go to our website, practice area, Asset Protection California. You'll then scroll down. I know it's kind of hard to find. Scroll down, Trust-CFO, click that button, and that will take you to a landing page. And there's a web form that you can complete. And that web form goes to Trust-CFO, and then Trust-CFO and I have a conversation, and then we can meet with you to go over your plan. So go to our website, CunninghamLegal.com, click practice areas, click asset protection, scroll down, click Trust-CFO, right? And so I'm going to put this back up here.
That information is all secure. It's hyper secure, internet server. And again, the intent there is to really help pre-qualify the relationship and the value for the parties. So we protect that information, and it'll show you immediately, yes, this has a great value to you because of your balance sheet, your financial statement, things like that.
And it's very important. There's no charge for this. So when you run that diagnostic, Ray looks at it and then he says, oh, this was a Cunningham Legal inquiry. And then we have a brief conversation about it. And Ray and I are good friends. And we just call each other on our cell phone and we say, okay, does this look like a good candidate or not? And it's very important that you complete all of the information, and then we can quickly determine if we should have a meeting or not, is the bottom line. So, if the purpose of a meeting is to decide if you should have another meeting, the purpose of filling in that form is to decide if we should have a meeting. So Harvey asks, go ahead and put your questions in the Q&A. Harvey asks, what action should a homeowner take on the home or property that is owned clear of any and all creditors? I have heard there is a risk of someone illegally challenging ownership. So I'm not sure. I think you might be talking about some type of deed fraud. That was actually a thing about a decade ago in LA. And that's why you now have to have your thumbprint on a notary journal. So if you've ever gotten something notarized in the last 10 years, you actually have to put your thumbprint on the notary journal. That is new to California. I mean, I think that may be unique to California, but you have to put your thumbprint on there because there was rampant, frankly, theft of title, and people were borrowing on properties, and it really was ugly. So they tightened the screws down on the notary journal. But Ray, how might you structure if somebody has a home? Let's say they have a home, and they want to protect that. What might that structure look like?
Well, again, some of the basic things that we've seen people explore with their next door neighbor or something is just having some other party encumber and say, well, I'm going to put a deed with my plumber and see if that can encumber this property. And that's, I think, what they're referring to. Okay. The difference is when you have an exempt plan or trust like a private retirement plan, it's a legal financial obligation, and it's like a bank, and you have the documentation supporting it through a promissory note, a pledge agreement, interest payments. And therefore this consideration, and that's how you secure equity if you're using a private retirement plan. Now, Cunningham Legal has up some other tools, things like a QPERT, if perhaps there's no mortgage on it and a client wants to reach some other estate planning objectives. But there's a multitude of things that should be analyzed, and the bottom line is flesh out the greatest value. The biggest benefit to least cost creates the most value. We've just found that because of the style that our clients have in trying to meet the shortfall of the private retirement plan, we need to protect the hen house, which is their balance sheet that's generating income to fund the retirement is at risk if something happens, and therefore we have a protected balance sheet, oversee and protect the exposed balance sheet. That's the mentality.
So I get some questions. What is the Code of Civil Procedure section covering California private retirement plan? What's the code section? 711 dot.
704.115.
704.115. 704.115. Stephen asks, how does the initial actuarial analysis take into account a defined benefit plan? You want to answer that, Ray?
Great question. We don't do private retirement plans unless we've vetted all current existing retirement plans, because in a vacuum, what the calculation is looking at the spectrum of a client over their accumulation and their distribution life to mortality, actuarially and finding out what they currently have in a 401k, defined benefit, IRA, which, as everybody on this call knows, is limited. You can only put so much in. And for our clients, the disparity is massive. You're always going to find that they're millions of dollars off, and none of these other tools are able to help them. Most of our successful business owners don't even fund a 401k. It's like throwing a deck chair off the Titanic. It isn't going to do anything. So that's a great question. We will forecast that and account for it, and then model on top of that the shortfall, and that's what justifies the need for a private retirement plan funding. And we won't exceed it, by the way. We've had almost everybody we meet says, well, I want to put more in. Sorry, this is the limit. This is what we can prove. If we were sitting on the court testifying and we had to justify actuarially that you needed this.
And if people want to do asset protection beyond that, there are other alternatives, offshore planning, other states, that sort of thing. But for Californians, I say, when people call me and they say, Jim, I've got 10 million in assets and I want to protect I want to make sure that if I'm sued, I don't lose my 10 million bucks. You can protect a whole big part of that. Not all of it. You got to leave a nub out there for creditors. You can't make yourself insolvent, but you actually can designate those as retirement funds and they're protected. So Mahesh asks, when we roll over funds from a company 401k to a self-directed IRA, do we lose protection afforded by the 401k? You want to talk about that, Ray? First of all, Mahesh, it depends on the state in which you live. And you want to talk about California's exemptions, Ray?
Yeah, so well, IRAs are a bit of a monkey. They are under federal law, under section 408, not 401, and they come under bankruptcy law, and they're exempt only up to $1 million indexed. This year, it's $1,283,025, and that's only in bankruptcy. In non-bankruptcy situations, it then depends on the state in which you live in, which California says it's not exempt. So the answer to your question, my friend, is the luxury you have is called tracing, is that when you roll over from a qualified ERISA plan, so if you'd funded into a 401k and you had rolled it over into an IRA, okay, in a SEP IRA, you retain that exemption from the origination of the funding.
Under California private retirement plan structure.
No, he said SEP IRA.
No, he said self-directed SD IRA. I think he meant self-directed IRA.
Well, okay, that falls under the same thing. Okay. He's probably talking about something he did with, real estate in a plan.
Yeah, because self-directed, Mahesh clarifies self-directed IRA. So it sounds like you might be taking money out on a 401k and then buying real estate. I'll tell you, the real estate inside of an IRA, I know a lot of people talk about that. If it's structured properly, you can. If it's structured properly, you can do it. One benefit of owning real estate is depreciation and all this other stuff, and sometimes you can't get that if you have a self-directed IRA. So, Anne asks, can one borrow from this private retirement plan? You want to walk through that?
Yeah, the private retirement plan is a much more flexible animal than you'll find in the federal tax-oriented codes like 401k and IRAs. Because again, they're hyper tax oriented. They want to account for the money going in. Yes, you can defer it, but we're accounting for everything going out, and you only get to have so long. The private retirement plan is non-qualified, so there's no limitations per se. Again, we have to have a legitimate design, and the answer is yes, if it's an appropriate investment. We don't have loan regimes for somebody to borrow that and go buy their Ferrari or their vacation house. But if they were to borrow it to go start a new business, just like you might have an estate planning trust, that Mr. Cunningham always has, is, as long as it's an appreciating asset and then the trust itself has a lien, protected lien, that because it then owns that loan, just like a bank. I'm an ex-banker. I wear the banking hat, and we have all the documentation, just like you were dealing with Wells Fargo. This one just happens to be a little nicer bank.
Stephen asks, what is the actuarial target amount and how is it determined?
It's based on the actuarial tables that the IRS actually just sent out and published. I got a list, we're loading them right now. And we found that you cannot say, we're gonna fund a private retirement plan and we're gonna live off of interest only to age 86, my mortality, and then I'm gonna leave a bunch of principal to my heirs. Well, then that's not true actuarial retirement. It has an excess, and that becomes an estate oriented plan. So what we do is we'll take in, it could be in consideration with one life. It can all be in consideration with 2 lives. But basically, you know, it's somewhere around the 86 mortality mark for most people. And then as of course, as you get closer to that, it might be a little longer than that.
Anne asks, can one use it, a private retirement plan, to buy real estate for investment purposes? Yeah. I mean, that's a lot of our clients, they fund, you know, you got $1 million sitting in the bank, you set up a private retirement plan, you put that money into the retirement plan, and you go and buy real estate. All those benefits of owning real estate flow through to you on your 1040 because we're using what is called a grantor trust status, grantor trust structure. A living trust, for example, is a grantor trust. It means the person who puts the property into the trust is treated as the taxpayer. You don't have a separate income tax return to file for the trust. It's all reported on your 1040.
The one thing I have to comment is, we watch this closely, is if Ann said, well, hey, I'm going to buy a piece of appreciating property, let's say it was a retail center, and we fund that in the private retirement plan, it's owned, it's exempt, okay, even with bank loans that it can co-sign on, and now it's building equity, that's one part of the asset growth for the retirement plan. What you can't do is then say, well, then all the rents that come into that, I'm going to peel out, and I'm going to go live off of today. That's not retirement. It has to go into the trust and keep accumulating. And then, yes, you can go reinvest it back in more appreciating assets until such time as we've decided what your retirement date is.
And we have some, let's see. Okay. It looks like we have reached the end of our questions. What I'm going to do, I want to thank you guys for coming here today. Ray, thank you so much for taking time out of your busy schedule. I know this is a super busy time of year for you. And I want to encourage you guys, watch us or subscribe to our YouTube channel, and so you can stay abreast of these great presentations. And I want to thank you for being here today. Ray, I'm going to leave this screen up here when we go off camera so that maybe you can go in and fill out the diagnostic and get started on this. So Ray, thank you very much for coming, and thanks for spending some time with us today.
Jim, I'll see you soon.
Okay. All
Thanks.
right. Bye-bye.
Have a great day.